Let's talk about yields and where they go next. I assume they're going down because right now the market assumes the Fed is going to cut down that Fed funds rate at least 2 or 3 times this year.
Yeah, it's become a trending market rather than a range-bound market.
Yeah.
You see yields continuing to fall, and it's probably to the surprise of some because many think that the inflation rate's still high. Many think that yields have fallen enough, but in a trending market and with the Fed embarking on interest rate cuts, a regime most likely, it's still early innings to be a fixed income investor. It's still early innings in the sense that there'll probably be good returns for the next couple of years. So, so we would suggest that investors be in a buy mode for bonds for the next 1 to 2 years, simply because that tends to be the trend in terms of how performance goes.
When you say a buy mode, are you talking maybe longer duration bonds, the idea of you're locking in interest rates, or something more shorter term where you're taking advantage of the price action?
It's a nuanced opinion, view. We would say extend your duration, meaning out to the intermediate part of the curve, called the 5, 6, 7 year part of the yield curve. In fact, I'd like to call the 5-year the long bond of the short end. It tends to react pretty well to changes in short-term interest rates. That said, that's an extension from T-bills, let's say. Many are parked in deposit accounts, very low duration. But when we think of duration firm-wide at Pimco, we're thinking to be more tactical now because yields have fallen pretty fast, so more cautious about the very short end of the yield curve, where there's a lot of pricing for interest rate cuts. So that's a view when thinking about indexes like the Bloomberg aggregate, which has a 6-year maturity or duration. We want to be somewhat neutral to that, even the slightest bit underweight simply tactically, but that's much longer, the 6 years, than T-bills.
So Romain talked about this, and you just mentioned it as well, all that pricing in of rate cuts. If you pull up a chart, you look at how there's a Fed cut priced in for every meeting for the next 5 meetings, which is pretty remarkable given that the Federal Reserve has not even embarked on the first rate cut yet. What are you thinking in terms of how much investors or traders will be caught offsides here?
Well, it has us thinking back to the start of the year when the bond market thought that there would be about 150 basis points in rate cuts, and this certainly will not be, but we may get closer to that. And investors shouldn't really concern themselves all that much about the one meeting or the next, and think about the end game. And the end game for the bond market is a pricing for a 3% policy rate. That seems pretty reasonable, and that's for the rest of the decade. So imagine in a case where there's a recession. The Fed itself, in its quarterly summary of economic projections, says that the neutral policy rate is 2.8. So what if there's a recession? Typically, in a recession, the Fed brings the policy rate below the neutral rate. So it's quite possible somewhere in the future, somewhere in the rest of the decade, based on those data, that the figure's in the 2s. And so therefore, there's room to run. And so that gets you out of thinking about the next meeting and the meeting after that as an investor and thinking about locking in today's yields, a Bloomberg aggregate at 4.5%, with inflation probably headed into the low 2s. It's already at 2.5-ish based on the Fed's favorite gauge. And that's pretty attractive relative to that. And so it's time to lock it in and think total return.
There's one thing that you point out, which is that people are a little bit too fixated on the Fed's 2% objective. That's kind of not arbitrary, but it doesn't really capture the spirit of what the Fed is trying to achieve.
Right. I'm glad you point that out, Scott. It's one of my favorite topics because, you know, I've been in the business for a long time, since the 80s, and the Greenspan era, the Volcker era, and of course, Bernanke and Janet Yellen. Before 2012, we didn't have a number. We didn't have a 2% figure to guide us as investors in the stock market, the bond market, or even in real estate. We had this notion of price stability, which Alan Greenspan, the former Fed chair, and Paul Volcker, the legendary Fed chair before him, defined as a level of price changes that ceases to have impact on household and business decision making. That seems to be the case. The economy is performing well. And the data all show, there's a final point, that when the inflation rate's somewhere in the 2s, call it 2 point something, just simply stable, that the correlation between bonds and stocks is pretty normal relative to history, which is to say, when stock prices fall, bond prices will rise. And so the correlation, you can depend on it when the inflation rate's stable. And that's the key thing to be thinking about, not the 2% figure, because that'll keep you from buying bonds and stocks and doing other things in markets.
But it raises a lot of questions as to whether we need to even get rid of that 2% figure altogether. I mean, there are some people who say we should never have adopted it to begin with. But the idea is that we're talking about a marker in the sand that even the Fed now has said should be a little bit more squishy than what it used to be.
Well, it probably won't get rid of it because it's an anchor, and plus it's been socialized as a figure. It probably won't raise the number because that'll set off alarms that the Fed might tolerate an inflation rate near 3%, which it clearly won't. So it'll probably be happy that the inflation rate's stable, the Fed, if in fact that's what happens, and that's the end game. But it still will persist until it reaches the 2% objective.
Yeah, you kind of wonder, like, what happened before we had that 2% target? We were all just going
there.
better.
You simply had to go on the notion: are prices stable or not? Is it a threat to me? An investor, a household, or a business?